Welcome back to my channel. Please ensure to subscribe and to like this video. So moving on, we're looking at leverage explained bracket pros and dangers of leverage. So first of all, what is leverage? In finance is the practice of using borrowed funds to increase the potential return of an investment. It acts like a financial magnifying glass, letting investors control a large positions with a relatively small amount of their own money, often called margin. While leverage can amplify profit, it is also increases losses, making it a high risk too. Key takeaways: definition: using borrowed money to boost investment exposure. Double-edged sword. I like this one very well. Gains and loss are magnified proportionally. So yeah, I like yeah, two-sided. Margin requirements: the portion of the total position a trader must deposit as collateral. So what is the risk? Losses can exceed the initial deposit. Sometimes triggering margin calls. So sometimes you might have $15 in your account and the market goes against you and you see minus $2, and you'll be like, how come? It's because of the leverage. And moving on, what are the advantages of leverage? Number one, we have amplified returns. Successful traders produce large gains relative to the initial investment. Number two, increased buying power. Control large position with a small deposit, 1,000 controlling 100,000. So you can have $1,000 in your capital as a capital, and when you start to trade, the leverage goes up, the margin goes up, and you can take higher lot size. The more the market goes profitable for you, the more your lot size can increase. So it's just like you're borrowing from the institution. So number three, we have capital efficiency, frees capital for other investment or diversification. Market access makes expensive markets or instruments accessible to smaller investors. So number five, we have profit in low volatility market. This allows meaningful gains even when price movements are small. So what are the risks to or risks of leverage? So magnified losses. Small advice price movements can lead to large losses. So you can literally just lose all your capital within one move. Margin calls liquidation. Brokers may close positions if account balance falls below the required margin. Account total account depletion. Higher leverage can wipe out an entire trading account quickly. Number four, we have funding cost. Overnight leveraged positions may incur fees or interest, which is swap cost. Number five, we have the psychological pressure. High stakes can lead to press and impulsive decisions. What are the types of leverage? Types of leverage: we have financial leverage, borrowing funds to buy assets, e.g., stocks, on margin or mortgage. Number two, we have operating leverage, using fixed costs in business to boost profits when sales rise. Number three, we have combined leverage, the total risk combining both financial and operative leverage. So what are the risk management best practice? Risk management best practice. So you have use stop loss orders. So as a trader, number one thing you should always learn is using the stop loss. Using your stop loss gives you an edge on the market, not to lose more than required, not to become scared of the markets, stuff like that. So automatically exit losing trades to limit losses. So number two, we have start small. So this is one of the biggest problem about traders. They don't want to start small. They just feel like, okay, turn my $10 into $500 within 1 week. That doesn't happen. It doesn't work like that. So begin with low leverage ratio like 1.5 or 1.10 ratio. For instance, if you have a $100, you should be looking at using one. If I have a $10, you should be looking at using $1 to trade, not using the whole $5 to trade. So, but like what I'm saying is, you should always make sure to start small. It doesn't necessarily mean that you cannot build to become big. Monitor positions closely. Never trade on margin without tracking positions. You should always learn to track position. You should always learn to stay on chart. It helps. Avoid over leveraging. Don't use maximum leverage. Leave room for market inflation.